You've probably heard the Fed talking about a soft landing. Sounds harmless, right? But what does it actually mean? Today we're breaking down one of the Federal Reserve's favorite phrases, soft landing. Where it came from, what it means in plain English, and why history shows us it's easier said than done. Let's get into it. Let's translate the Fed's jargon. A soft landing refers to a situation where the Federal Reserve raises interest rates to fight inflation without triggering an actual recession. This is a very, very tricky territory that they get themselves into. That means no mass layoffs, no GDP contraction, and no financial crisis. Just a nice, gentle slowdown. Just tap on the brakes. Like putting a turbocharged economy back on cruise control without blowing the engine. Going 60 miles an hour, throwing it in reverse, and expecting the transmission not to drop out. The term actually emerged during the 70s and 80s, when central banks were desperately trying to control runaway inflation without pushing the economy into full-blown recession. Spoiler alert, they didn't succeed. What the Fed really means. When Jerome Powell, or J. Powell, you can tell on which way the economy is going, whether his moves are positive or negative. He's either Jerome or Jay. I've noticed that too. So when Jerome Powell or the other Fed officials talk about a soft landing, what they're really saying is we'll raise interest rates just enough to slow inflation, but not so much that we're going to completely tank the economy. In reality, it's basically like walking a tightrope during an earthquake. The Fed is trying to hit the Goldilocks zone. This is where the inflation falls below 2%, unemployment stays low, consumers keep spending, and the market doesn't panic. But here's the Austrian economics take. You can't centrally manage the economy without distorting the actual signals that you need to make the decisions. The Fed sets the price of money, and the more they manipulate interest rates, the further they get from the real market correction. How the Fed tries to achieve it. Here's their basic playbook of a soft landing. First, raise interest rates slowly. This is to discourage borrowing and cool inflation. Second, watch the labor markets. If unemployment stays low, they feel confident. Third, pause rate hikes once inflation starts falling. Fourth, maybe cut rates later to avoid tipping into a downturn. But the real challenge is the lag time. Rate hikes take 6 to 18 months to fully impact the economy. By the time the Fed feels the slowdown, it's often too late. That's how soft landings become a crash. So has the Fed ever pulled this off? The Fed claims they pulled off soft landings in 1994, 1995 under Alan Greenspan, and maybe 1984 under Volcker. But even these examples are debated. Most of the time, tightening cycles end in recession, not soft landings. 1980s hard recession, 2000s dot-com bust, 2008 financial crisis, 2020 COVID shock, with years of low rates before that. From an Austrian perspective, these cycles aren't bugs. They're features of a manipulated economy built on cheap money and delayed consequences. So can the Fed pull off a soft landing? Maybe, but it's like trying to defuse a bomb with a blindfold on, and they're the ones who armed it in the first place. In a real free market, interest rates aren't just set by committees. They're set by the supply and demand of capital. Until we return to a sound money system, we'll keep repeating the cycle of boom, bust, and bailout. If you found this video helpful, make sure to like, subscribe, and share it with someone who still thinks the Fed is managing the economy. And I'll see you in the next video.